Welcome to the second of 3 lectures on Engineering Economics Fundamentals. In this lecture, we will talk about benefit cost assessment decision criteria, the second item on that list. The 3 decision-making criteria that I'll discuss in this lecture are net present value, equivalent annual uniform cash flow, and internal rate of return. Net present value is often abbreviated NPV, and in this we use the concept of equivalence, the idea that we are equally value a cash flow in the future and the discounted present value of that cash flow. So we convert all the cash flows to present value. If we have a lump sum future value in year N, we could convert it to present value using this formula here. And let's say that we have an annuity. We could use the formula for an annuity, or here I'm actually showing the Excel function, which would convert an annuity into a present value. So whether they're discrete cash flows that get discounted using this formula here, or annuities that get brought back to present value using this formula, we sum them all together, and that sum of the present value is the net present value. The decision-making criteria, if it's simply one project that we are looking at in isolation, so we can either pursue it or not pursue it, so that's a go or no-go decision. Then if the net present value is greater than 0, it's a go and we pursue that project. If we have mutually exclusive projects, then we choose the project that has the highest NPV. This is appropriate for projects with the same time horizon. So we wouldn't, for example, want to compare the NPV of a project that goes on for 30 years with the NPV of a project that goes on for only 10 years. The 30-year project might generate a greater NPV over its project life than the 10-year project, but presumably that 10-year project, after it was over, we would be able to do something productive with our money besides invest it at 0 interest rate. So in that case, we would, if we assume that the 10-year project is sort of implicitly repeatable, we could do something else productive with our money, then it would be sort of unfair to the shorter project to compare a project that maybe earns a lot of money over a short time period with one that earns perhaps a greater amount of money but requires a longer amount of money to generate that net present value. So we only use this for projects with the same time duration. In a sense, net present value is asking you, is this project better than a passbook savings account that has interest rate I? So is the project better than simply getting interest rate I each year on a given amount of money? So you could have a project that generates returns such that the annual returns exceed the initial investment. That would be a positive accounting profit, because you're getting more money out than you got in. But what NPV says is it better or worse than a savings account that would get you I, where I is the interest rate that you would get from the other option that you would pursue. Again, the safe savings account. I is often called the minimum attractive rate of return. So if NPV is getting greater than 0, you are generating more than the minimum attractive rate of return. You are doing better than, making more money than that passbook savings account at the minimum attractive rate of return. If NPV is 0, you might actually be getting more money out of the project than you're putting into it, but you are getting less money out than if you pursued the alternate investment of the safe passbook savings account at interest rate I. Equivalent uniform annual cash flow is a 2-step process. Usually it's just easiest conceptually to calculate the net present value and then convert that net present value to an annuity over the life of the project. You can also directly take all the expenses and convert them to annuities Usually it's easier to go through that step of converting the net present value. People are used to how to do the net present value. So you take that and then you spread it out as an annuity. And here I'm showing the Excel function to take a net present value and turn it into an annuity. It's the payment function where we specify the interest rate, the number of payment periods, and the present value, which in this case is our net present value. So if it's a go, no-go decision, we've got a single project whether you're going to pursue it or not, then if the equivalent uniform annual cash flow is greater than 0, we go. If we have mutually exclusive projects, we want to choose the highest equivalent uniform annual cash flow. So this allows considerations of repeatable projects with different time periods. So you can take a 10-year project and a 30-year project and turn them into annuities, one over 30 years and one over 10 years. It is implicit in that the 10-year project is repeatable, that you could do it again. But typically projects are, and so in that case we would be able to compare, using this metric, the two projects with the different time horizons. Again, this is similar to net present value in that it's asking not just is this producing positive cash flow in accounting terms, but is it producing more cash flow on an annual basis than if we invested in a sure investment like a passbook savings account at interest rate I, where I is the minimum attractive rate of return. The third metric or decision criteria is called internal rate of return, often abbreviated IRR. Here, its definition can sound a little bit counterintuitive, but in some ways this is the most intuitive of the metrics. It is defined as the value of I that makes the net present value go to 0. So again, that might seem like a bit of a convoluted definition, but keep in mind that net present value is the returns above what you would get in a passbook savings account. So in a sense, this is saying if the project were a passbook savings account, what interest rate would it pay? If the project were to pay out uniformly a percentage of investment, of your initial investment every year, what would that uniform return on investment be? Think about this as that you usually start with a negative cash flow, your investment up front, and then you gradually start to generate positive cash flows over time. So most projects will have a positive net present value for a very low interest rate. You know, give them long enough and they'll get the initial capital investment back. But as we start to get a higher interest rate, we start to discount those future cash flows, and as that interest rate climbs, you will finally get to a point where the future cash flows don't balance the initial investment and the net present value goes 0. And of course it's that value of I where they're just balanced, where the initial investment is just offset by the future value of the positive returns and the net present value is 0. That point is your internal rate of return. So the present value of the investment and the returns are equal at the IRR, and when you have an interest rate less than the internal rate of return, so when the actual interest rate is less than the internal rate of return of the project, we'll generally have a positive net present value. So the decision making here, if it's go or no go, if the internal rate of return is greater than I, where I is the minimum attractive rate of return. So if the project returns more than the minimal attractive rate of return, you go, you pursue it. If we have mutually exclusive projects, if they have identical initial investments, then it's okay to just compare the IRRs and choose the higher one. The problem you get into is when the projects are mutually exclusive and they have different initial investments, which of course would be very common for different projects to have different initial investments. So there is an approach that if you've taken an undergraduate engineering economics class you learned, which is called incremental rate of return. And in that case you compare the incremental investment in the larger project to the incremental return on that larger project. And if the incremental IRR is greater than I, you would choose the larger project. Okay, practical advice, however, net present value is usually the easiest way to go. Usually you have projects that have different initial investments but similar time periods. Equivalent annual uniform cash flow is nice because it's sort of almost always works. As long as your projects are repeatable, then you can compare even projects that have different time horizons, different initial investments. It always works. IRR, again, it has an intuitive interpretation. It's saying if the project were a passbook savings account, what interest rate would it pay? And so people like that. They compare it to borrowing and lending rates in the market, and it's very nice that way. But again, it's a little bit complicated if you have investments with different initial investments, and there is a procedure for dealing with that called incremental analysis. If you learned it in an undergraduate class and are comfortable with it, that's great. You can use IRR, but it is a little bit more complicated to apply in the very common case where you have investments of different initial sizes. For example, you might have an investment of $1 that earns 100% interest, so it gets you another $1 back. And that's great, but in absolute terms, it's only $1. Whereas you might have an investment of $100 that earns 10% interest, and which would return $10 in a year. So you might rather have the larger return, the $10 on the $100 investment, even though the IRR of that investment is actually lower than the 100% IRR on the $1 investment. So it's those issues of, do I want a smaller return on a larger project, that make IRR somewhat more complicated to apply. And again, usually net present value is just the easiest way to go if you do have the situation of repeatable projects but different time horizons. Then you probably want to go with equivalent annual uniform cash flow. And this concludes the second of the 3 lectures on engineering economics fundamentals. Thanks for your attention.